Welcome to this month's edition of the Student of the Market. This is the April 2020 early edition, and we'll be looking at activity over the past month. As you know, the markets have been quite active, both up and down, over the last month with the COVID-19 virus. So we're going to take a look at some of the activity, what's happened, and what we can learn from it as we move on. So let's begin. So first is this chart, just real briefly, a lot of data to look at here. But if we were to look, the worst days, weeks, and months in the S&P 500 since 1950. So if we were to look, this is why March was so unique, is if you look at the worst, days since 1950, well, we've experienced three of those. You can see here and here. And it's still to be seen here what the return is going to be, a year from now. So again, if you're looking at, 20 of the, worst days, three of those happened in March of 2020. And then we'll look at the worst weeks. Again, you see 315 was down 15%, February was down 11, and then of course, here. So I mean, again, what's going to be the return a year from now? Of course, we don't know. But if you're wondering, wow, this past month has been really crazy. Well, it has been, historically speaking. I mean, three of the worst days in the last 50 years have happened. Actually, 70 years, and three of the worst weeks. Now, the interesting thing is, if we look, this is the key point here, is that historically speaking, a year later, historically, again, past performance is no indication of future results, but we can look at the average return from a worst week and worst days, 24% and 14% respectively. So just something to look at and be considering. That's the importance, again, of staying invested. So the next piece we'll look at is kind of anatomy of bull markets, and this is interesting because this is how many times have we been down 19% or more since 1950. And I think what I want to show here is just go through the last four periods, and we've seen that in 1998. That was the beginning. That was the top of the last bull market, and then of course, a run up to 2000. We saw that. Then of course 07, which is the Great Recession, and then one we most felt recently, of course, was in September of 2018, and then all the way to Christmas Eve, down 19%. So it's happened. Now here's what's interesting. While this is important, is if you remember, back to 2000, it took 637 days to recover. In 2007 to 2009, it took 355 days. And then of course, this is why our last quote unquote 19% drop didn't feel so bad, because it only took basically over 2 months to recover. So who knows? This next period that we're in is going to be different, of course. But we have been here before, and so again, if you're an investor in the markets now, the trick here is to just stay invested. And if you're just getting into the market or just looking to get started, again, time is on your side. So next piece is, now that we've looked at the downside, let's look at kind of the upside. If we scroll over here just a little bit, here's anatomy of a bull market. So, and we'll just again look, there's plenty of information, and you can review this slide because we'll email it out after the presentation. But you can see from 12/24/2018 until just recently, March, I think 10th, that was a 24% run up, and it lasted 81 days. This is very important though, this piece right here. If we look at March 9th of 09, And this bull market, if you will, lasted, 1,008 days. And the importance that that brings is if we look over time, next to 1974, that was the longest bull market that we had. Well, 74 and 02. So quite a long time of just straight upward climb. So, we kind of got used to that. And so when the markets did what they did in March, it was really a shock because, we've been at it for quite some time. So, but this is the key to look at. The average performance 1 year after a bear market is 35%. The average 3-year return is annual return is 14.1%, and again 11.2% average 5-year return. So the important piece here is to stay invested, stay diversified, and again, if we're in a bear market and it turns around, typically if you're in the middle of it, which we are, you'll want to stay invested because again, no past performance does not guarantee, or indicate future results, but it has worked out in the past. So this one's important. I think probably one of the most important slides in this deck because everybody is trying to time the bottom, right? So if we take a look, this is very important. So this goes back 70 years to 1950, and this is the average 1-year return, all periods going back to 1950. And so the average 1-year return is 8.9%. Not bad rate of return, basically 9% a year if you're on average for an investor in stocks since 1970. So that's a good benchmark. However, if you're trying to time the market, and you're trying to, am I going to be too early? Am I going to be too late? So this next piece is very important because let's say that you missed the bottom by 2 weeks. Okay, so you know what? I want to get invested, but you missed the bottom by 2 weeks. You're kind of late to the party. You still would average 21% 1 year later. If you're early, let's say, you know what? I put my money in, and the market kind of oscillate a little bit. Well, if you're early to the bottom, 24.2%. So still not bad, okay? But to be perfect, you mean to absolutely call the bottom of every bear market since 1970, which would be very difficult to do. You would average 35%. Okay, 35 is better than 24, but the reality of actually timing that's very difficult. So again, the importance of staying invested and especially in not trying to time the bottom is if you're in the entire time, you don't have to worry because you're going to capture this 35%. If you're trying to time it, let's say you're 2 weeks early, you might miss 10% of the return. So if you have cash on the sidelines and you're waiting to try and time the market, our argument's going to be, well, history has said just get in as soon as you can. So considering the fact that it's 35% down, of course, we'd have to look at your individual goals and considerations before we just up and, make a crazy recommendation. But for the most part, if you're looking to invest, then you'll want to stay the course, stay diversified, and be in the entire time, so that way you don't miss the bottom. So we'll move to the next slide here, a little bit different. So overall, what does the best coming out of market bottoms? Again, historically, smaller companies tend to fall harder, so they tend to bounce back a little bit more. Large growth stocks, so those would be, those are your Apples, your Microsoft, and then of course, and then there's your large value. That's your, that's your Walmarts, your Johnson & Johnson. On average, just being invested in the United States stocks, 41% bounce back following bear markets. So, again, there's the graph in there with a ton of different, data. Excuse me. And so I think, that's something to consider. But again, staying invested and being there in the United States stock hasn't hurt you over time. So again, each portfolio is different. So we'd want to look at your individual portfolio and make any particular adjustments if needed. But the bottom line is, if you're invested, the market tends to bounce back relatively strong after a bear market. This too is an important slide. This is kind of speaks to people's emotions. And there's been times in the past where we've had these conversations with clients, and this graph goes back a little bit. So this reveals a 60-40 portfolio, so 60% stock, 40% bond, and cash. So if we were to look, there's this first part where, the your portfolio is down 18% and the S&P is down 40. You still feel like you lost money, but you know what? You didn't lose as much as the S&P. And then, of course, this is the one that we have the most conversations with clients with, is if the market's up 82%, you're only up 73. It's like, I didn't make as much money. And then, of course, we're back to, I lost money again, then I didn't make as much, and then I lost money. And then if you look, this is what's intriguing, is over the same period of time, you can see that $100,000 in a diversified portfolio did better than the S&P, even though there were periods of time when you felt like you weren't making as much. So the bottom line is, a diversification wins even when it feels like it's losing. So just want to stay invested there. How long might we've talked about a recession. Some economists have, pegged this to be, the economy to drop 20% on an annualized rate in the second quarter of 2020. And we're just entering that quarter. So we'll see what it says, what happens. But what's interesting is the average expansion. So that's when things are going well, lasts 60 months, and the average recession lasts 13.3 months. Well, the good thing is that the expansions last longer than the recessions, which is historically good. But this is why perhaps this one that we're in is coming at a shock, is one, because it happened so fast, and two, we're in the longest expansion in history. So that just ended with this recent, we'll see what the data says for March, but this expansion is likely to end in the second quarter of 2020. And you'll see that that would have been, after that particular period of time, 126 months is the longest expansion. So we've had a really good run. And that's why I feel that, a lot of economists and our economists here at LPL feel that the market, and BlackRock, if you will bounce back relatively well, because we were going into this particular recession really strong. So again, history is no indicator of future performance, but it does give some clues. And so we'll want to be watching that. The nice thing here is that historically speaking, the average recession, 13.3 months. Our most recent recession was 18. And that was back when, banks were failing, and, our economy was not as stable as it is, at least before the coronavirus. So market performance during recession. So, what's happened, again, this speaks to diversification. If you're just 100% in stocks, a 1.2% rate of return. If you are in bonds, historically 8.2, and then of course the average, of a 60-40 balanced portfolio, 4.3%. So you want to be diversified. Now the trick is, I get this question a lot, is, Jason, why don't you just put all of my money in stocks, in bonds, so that I get that 8.2 percent return? Well, that's just during the recession. And again, the average recession is 13.3 months. So, that's again, we have to have a long time perspective. And you've seen some of the return numbers from stocks, and that's why we have most of the portfolios and stocks. But the key here to learn from this graph is if you're diversified, like most of our clients are, you have, you'll eke out a better return than being in stocks. So, and there's certain asset classes that do different. Large growth stocks typically don't do as well as U.S. bonds. U.S. stocks, do better than international stocks, historically speaking, and then large value, small cap. So we just kind of, again, that's the reason to not have, when we build a portfolio for you, is we're going to have diversification amongst all asset classes so that you can experience different rates of return. And that, ladies and gentlemen, is the end of our presentation on the student of the market. You can review this if you would like at your own leisure. There'll be an attachment that we'll email out to you, and go ahead and review it. If you have any questions, please don't hesitate to call us anytime. Thank you again to BlackRock for providing us with this material, and we'll look forward to seeing you next month on the Student of the Month. Thank you.